This is Philip Chao. I'm the founder and chief investment officer of Experiential Wealth. So as of May 7th, 2023, going back to the beginning of the year, you may have heard that there have been 3 major bank failures. Now, when I say major bank failures, or maybe these banks you have not heard of, but they're not little banks. One of them you may have heard of is Silicon Valley Bank, SVB, $209 billion of assets. Another one you may have heard of is Signature Bank, $110 billion in assets. And then First Republic Bank at $213 billion. If you add the 3 together, the size is more than what happened during 2008 bank failures, just that 1 year now. So this is, serious. What does all that mean? Bank failure sounds horrible. So let me perhaps help to dissect this a little bit. So if you're a bank, when you take in all these deposits, $209 billion, $110 billion, $213 billion, these banks, what do you do with that money? There are only 2 things you can do with it. One is you put in some kind of savings, which in this case, US Treasury securities, and you're making interest on that money that your depositor gave you. The other is lending it out. If you remember, in the last 15 years, you have earned very little by putting your money in the bank. They gave you 0 interest rate to very small amount of interest. Because why? Interest rates overall have been very low. Bank is making a little bit of interest by depositing their money in the US Treasuries, which pay them above 0. So if they pay you 0 and they make, let's say, a 1/4 point or a 1/2 point, that's the spread, and they make money, and then they can, do whatever they do with their money in terms of for their reserves, and as well as lending it out and so on. So now, when interest rate goes up, bonds price go down. It's exactly inverse. So interest rate go up, the worth of the bond that you bought have lost money. So you can imagine the $209 billion becomes something much less than $209 billion as interest rate keep going up. So the banks did not manage their investment correctly. In this case, at least these 3 banks have not been careful in managing their portfolio, because they have been pretty loosey-goosey with their lending to certain segment of the market where they are giving really preferential interest rate treatment for loans that is outsized loans. And they have given people deposits that is greater than the FDIC insurance amount of $250,000. So people may have millions of dollars deposit in there. So these are all, risky ideas and risky actions. So as interest rate continues to go up, their reserve amount keep coming down because because the value of their investment keep coming down. Ultimately, people get wind of this and people get scared, and they say, well, hold on for a second. The reserves is getting lower and lower. Is the bank still going to survive? Let me take my money out. So there's a run on the bank. That hurt it even more. Now they have to sell their assets at a loss to make up the amount of money needed to pay the depositors. They have a mismatch of assets and liability, and there's a run on banks. Now, the question is this countrywide? Is this something that every bank's going to experience? Well, this is not 2008 in the sense that money center banks like the JP Morgans, the Bank of Americas, the Wells Fargos, and all those large banks are in very good shape. They have tremendous reserves because of the new rules and new laws. But the smaller banks have not done as well. So is it possible tomorrow you read on the paper that there's another bank going through this similar situation, similar run on the bank, mismatch? Yes, it is possible. Perhaps it's even likely. But it's not systematic. It's not every bank's going to do this. So what can you do about it? A lot of people have already done this. Number one, a lot of people have moved their accounts from small and mid-sized bank to the largest banks. So in this case, the largest bank become the beneficiary. Their assets are growing like weeds because all the people are moving their money into the larger banks. And the larger banks, even when you move it in there, you want to keep it within the FDIC insurance amount, which is $250,000. That will be a great idea, because even if the large banks go under, you know your money is good. The second thing is to think about perhaps taking your money and look at other safe way of investing, such as the US Treasuries. And they are paying very high interest as well, and that is one route. Another route that some people are looking at is to look at money market funds that invest only in U.S. Treasuries and agencies. Now, U.S. agencies are the Fannie Mae, Freddie Macs, backed by the federal government. And they will continue to pay out a high interest rate, and the default is almost unimaginable because it's U.S. government. This is not advice to you, but these are the different things that people are thinking about, which makes sense. Hopefully this helps you to get a bit of an understanding and not to be fearful and not to overinterpret, but understand the reality of what has transpired and what likely could happen, meaning that there could be 1 or 2 or 3 more banks like this, or 5 or 10 more banks like this, but what actions you may contemplate for your money.